Hey, everybody. Welcome to the ChainLinkGod podcast, where we break down the information asymmetry on all things blockchains, oracles, and smart contracts. If you've been paying attention to my content for the past couple of months, you may have noticed that I've been focusing a lot more on the underlying fundamentals and value proposition of smart contracts, while pointing out some of the unsustainable growth strategies and Ponzinomics that the crypto ecosystem has been deploying for the past couple of years. And when kind of thinking about this problem and analyzing it, it seems evidently clear to me that tokenizing real world assets is really the way that the DeFi ecosystem is going to scale and serve the 99% of society. And when kind of looking at what protocols are tokenizing these assets, like fiat currencies, government treasuries, corporate bonds, real estate, etc., the protocol that has really done the most thus far, or at least at scale, from what I've seen, is MakerDAO. Now, MakerDAO is a DeFi protocol that issues the decentralized stablecoin DAI. And since the beginning of the year, they've been making various initiatives to onboard various real-world assets on chain as collateral. And the most recent initiative is they're working with a US-based bank to use $100 million worth of real estate loans and other real-world assets as collateral to back DAI. Now, I find this initiative incredibly interesting, and I truly think that this is the way forward for scaling DeFi. And who better to discuss this topic with than the person who is leading this initiative? So with the Crypto Oracle and I today on this podcast, we have a special guest. We have Teej Ragsdale. He is a real-world finance core unit member at MakerDAO, and he is helping lead these initiatives to bring real-world assets on chain so it can back the decentralized stablecoin DAI. So welcome, TJ. Could you provide a little bit of background on who you are and what you do for MakerDAO?
Sure, fellas. First of all, thank you for having me on. It's an absolute pleasure. I'm a huge fan. My name is TJ Ragsdale. As CLG said, I go by Teej with friends as well as folks in crypto. I was formerly a TradFi goblin. I was trading commercial mortgage-backed securities for about 3 years out of school, basically real estate bonds, pools of mortgages. Became pretty disillusioned, as I think many of us in the space who came from TradFi didn't really like corporate hierarchy or the investment dogma. So I quit and moved to Turkey for a bit and came back and figured I should work in crypto, which is my real passion. And the most sensible place for me to kind of do that was at this intersection of crypto and real world assets, and Maker was a leader in the space. So I've been contributing to real world assets at MakerDAO for about a year now, and that's where we find ourselves today.
Very cool. What do you focus on in MakerDAO? What do you kind of been? I know you're in like the real world asset domain, but what do you do specifically there?
Sure. So when we think about onboarding assets from the real world, obviously very different than issuing a loan against BTC or ETH. These assets are very complicated, right? They live in a world of legal contracts and courts and commercial structures and yada yada yada. And so what I do is, when the community expresses interest in exploring onboarding an asset, I really am the commercial risk analyst. So I look at that deal, I try to understand what the risks are to the protocol, what the opportunities are to the protocol, and explore a potential structure that may protect Maker token holders against downside. So I really just take kind of my experience from my old world and try to put together an assessment of risk such that token holders can do what they do best, which is onboard good collateral and avoid bad collateral.
So TJ, I had a question, just a kind of a foundational question. So when you talk about real world assets, like what types of real world assets do you like are there? Like could you maybe give like a general class of like what the different types you could see, like that you could see maybe making their way into DeFi?
Yeah, sure. So I think a lot of the real world asset space is iterative, and I don't think we've even seen the tip of the iceberg in terms of the potential combinations. But I think there's a wide range of these things that exist today that I think folks are familiar with. Maybe most won't recognize them as RWAs, but I think they kind of are. You've got things like USDC. That's really a real world asset. That's cash and, some short-term bonds that sit in an account. And then Circle issues a liability of those assets on chain. We call that USDC. But then Paxos, there's gold on chain. You see equities on chain through synthetics and FTX. Maker is trying to bring bonds on chain through Centrifuge. And then there's all kinds of like more interesting esoteric stuff that people are trying to bring into the mix too, like collector cars and wine and agricultural crop inventory. So we kind of see a wide range of stuff and combinations that folks are trying to bring into the world of smart contracts. But I think ultimately, there's a whole level of infrastructure, a layer of infrastructure missing, such that we can really see RWAs flourishing fully on chain. And that stuff is going to come as folks like Maker and Centrifuge and Chainlink and these sort of on-chain credit scores really mature. So I think we're at the very beginning, but you do see a pretty diverse range of RWAs already living on ledgers.
Yeah, I think you bring up a good point here is that we're already kind of seeing this in many ways with stable coins, which are just tokenized dollars, and dollars are just an asset minted by the government. But people typically don't think of stable coins as a real world asset, but that's really exactly what it is. I think that kind of stepping back a little bit, what is the value proposition of tokenizing a real world asset and bringing it on chain? And what's the value proposition of having a real world asset on a blockchain network versus an asset just tracked somewhere in a centralized database? Like, why would somebody want to tokenize an asset and why are they valuable?
Yeah, sure. So, again, I think at the end of the road, if we really build out this bridge between RWAs and crypto in 10 years, this answer will be so obvious in hindsight. I think it's a little bit more difficult to see today, but I would break down the advantages today to an asset manager bringing their asset on chain, tokenizing it, into kind of three buckets. The one is liquidity, right? So there's the potential to access a larger pool of investors. So the buy side is sort of expanding for these assets. In a sense, if you've tokenized a loan and you brought it on Ethereum, in theory, anyone with Wi-Fi and an Ethereum wallet could partake in the liquidity pool of that asset. So a potentially bigger buy side, more liquidity. I think the other thing is, if you think about the way traditional financial markets are set up, we have this construct called securitization, which was really a breakthrough moment for capital formation in the history of capital markets. You take loans, you package them together, you slice them up, and then you sell them off to investors as per their risk appetites. But the problem with that system is it requires a very sort of pretty bow around the assets. It only accepts certain assets. They have to be very standard. It's very picky. It's expensive. It has big administrative overhead. So I think bringing assets on chain, you can potentially bring a wider swath of assets, more esoteric assets, big ones, small ones, stuff from emerging markets, different jurisdictions. And it can live on chain, right? And I think that's probably appealing for asset managers. And second, I think, is this idea of information. So, you take an asset, that asset has a certain essence to it, right? It has a value. It has maybe a risk profile that changes over time as the environment changes. It has a history of performance. It has all of these qualities. And I think, when stuff lives in proprietary ledgers, silos in the outside world, it can be very difficult to have like a sense of continuity. That information is opaque, where if you take that essence of that asset and you have a single source of truth on chain, it's immutable, it's open, anyone can refer to it. I think that unlocks a lot, right? It reduces this asymmetry of information. It reduces administrative overhead. I think it gets at this idea of a transformation of capital markets through transparency. And I think the final one is the potential combinations, right? The stuff we can launch. It's really this idea of composability, right? You have these ledgers. on these ledgers, there's really this ecosystem of apps, of assets, of users, all of this capital and value being formed. And if you bring assets into that, right, there's a lot of really cool combinations for capital markets that simply don't exist when these assets are out in the real world, stranded in some jurisdiction with a few relationships. It just allows for a more expansive combination. So I would say those three: liquidity, single source of truth, and this idea of combinations.
I have a quick question on that. Do you think that you also introduce though new risk by having bigger buy side, like, you know, you kind of have almost this like global unlimited pool of assets, like you don't really know. Well, I mean, you could know or you don't know, like you could have buyers from all over the place and you don't really know maybe that much about them. I mean, I guess it depends on how DID and that kind of stuff develops, but do you see that as a potential risk? And also maybe this idea of like having too much composability where it introduces like new risks, you know, that we don't really, you know, fully understand yet.
Definitely. I mean, I think there's 2 points to that question. One is, are you exposing financial systems? I mean, if you don't know who your buy side is, might bad actors be investing in these assets when you don't want them to? And I think that is an absolute reality, which is also why I think this discussion of RWAs on chain really does go hand in hand with regulation. I think at least for Maker, you know, the time where, you know, we're, you know, secretly, you know, doing things in a corner and, you know, trying to be decentralized such that we can avoid regulation, that's of the past. You know, we're ready to deal with these issues seriously. RWAs deal with real world issues, and I think a reality is you must do them compliantly and make sure you're dotting your I's and crossing your T's. So I think that sort of sanction and AML point is a good one, and it's something that needs to be addressed. I think the other point is also super interesting. This idea that composability introduces sort of unexpected emergent stuff to the mix. If you think about what happened in 2008, right, there was all this stacking. I mean, it was really composability. And there were so many stacks that people only saw the top stack and didn't recognize the implications, the long string of sort of liabilities and contingencies. And I think that is a concern here, right? The more combinations you have this potential cascading effect. But this, I think, is why it's so important. If we're going to compose real world assets, we need to make sure upfront that we are building a level of transparency and auditability and accountability that does allow for those combinations and the positives of them without sort of incurring this, you know, this Lego effect, this potential for cascade.
Yeah, I think the transparency is really key there. And also, like, you have basically the ability for any number of people to be looking at the same data and then being able to come to probably a deeper conclusion on what the systemic risk is, as opposed to when everything is very siloed. Like, you don't have hardly any people that can actually, like, you know, figure it out themselves, but also then talk with other people about it. Whereas this kind of blockchain can allow a lot of people to crunch on the same problem with the same data.
Exactly. I think the auditability is key. A whole nother issue is, you know, just because it is auditable, will people actually look at it? But at least you can say, to the extent you want to investigate a system, how it's built, the collateral, you can go look at something, which I think is an improvement.
I think you made a point about regulation. I think that's definitely almost like the elephant in the room with real world assets. On one side, I could really see privacy preserving KYC being the future approach to this, but I think there's always going to be a subset of people who want to be, you could put a decentralization maximalists or just full people who want to go full trustless, and so crypto only collateral. Do you see there being a split in the DeFi ecosystem where there's a route of dApps going towards regulated and real world assets, and then a subset of ads going down kind of the fully permissionless, fully decentralized, crypto only can't be shut down? Do you see these two worlds splitting? Do you think they can ever be reconciled? What's your take here?
So I think there is definitely a split, and I think for the most part, the split will fall along lines of maturity. And what I mean by that is, I think one of the beautiful things about this space, about building on a censorship resistant ledger, is the ability to experiment with sort of new monetary systems, right? New primitives that, it's very difficult. It's a lot of friction to spin up these ideas in the real world. You build it on chain, you can see how users respond to it. You can see how it responds to shocks, et cetera, et cetera. And I think it's really important in order to preserve that creativity and that entrepreneurialism to have this unregulated sort of a laboratory. But ultimately, and I think kind of what you're getting at is, well, is a protocol's upside, its ability to impact the world, to have a large total addressable market, is it sort of capped if you're building in this kind of decentralized, lawless space? And I think to an extent it is, right? Ultimately, the purpose of these systems is to make a dent in the way the incumbent financial systems work. And so I do think at a level of maturity, if a protocol hits product market fit, it will be more natural for that protocol, especially now that it has the resources to do so, to explore compliance and to explore how to integrate with the real world in a way that, protects consumers and regulators are okay with. So I do think it does cleave, but I think it's less a fork in terms of, one side is doing illegal stuff, under the radar, and the other side is doing legitimate stuff. And more so, I think you want the laboratory to be on the permissionless, sort of low constraint open side. And I think you want the big protocols that have found product market fit with millions of users to probably explore the compliance side.
Just a quick point, a thought on that. Like, I think for me, the question is like, I do agree with you. Like, if you want to hit like true global scale, like you kind of have to play by these preset, the rules that currently govern financial systems. I guess what I would love to see though is how can you kind of work within those, but also push that foundation a little bit? Because, I think what a lot of people worry is that, well, it will just be captured by the same system that has already that we're trying to create a better system, not get captured by the existing system. So like, I'm very curious, like, what is the right amount of push versus, working within the current system? That's always a tricky dynamic.
Yeah, I mean, I think if a protocol stops innovating when they get to size and they try to fit in, the legal box of the last era, I don't think that makes much sense. And ultimately, I believe that, tech is always a front runner of culture and law. And so if we're not pushing for, new laws that are more amenable to the realities on the ground of crypto innovation, then I think we're sort of losing out here. I think another piece is, there's a kind of a race here in crypto to get to scale, because when you think about the game theory with regulators, you want to be of systemic importance such that, if regulators try to jam you into a box and constrain your ability to continue to deliver a product for your users, if by doing that, the regulators are kind of violating their mandate, and in fact, delivering more harm to the consumers that they're there to protect, I think that's sort of an interesting snafu, right? And this is also with real world assets. I think when you think about a regulator coming in here and knocking around, if you're doing all this stuff that's insular and sort of circular in DeFi, a lot of what you guys talked about on the last pod, then a regulator is going to look at that protocol much more differently than they are one that is in good faith trying to lay track to the real world, right? This HVB deal, we're trying to finance the engine of the US economy, small and medium-sized businesses. So I think as a regulator coming in there, I would hope they would recognize that as being something that's value add, and that will push the law forward, as opposed to really trying to jam us all up and put us in, last decade's box.
I think it'd be an interesting point is like just the move of crypto dApps basically to become so systemically important that ripping them out of the system would do more harm to consumers, rather than if you look at the casino kind of speculative Ponzi-nomic games and you rip that out of people's hands, it's not actually going to make that big of a difference in society. Most people won't really notice. But when you become so systemically important, then you can't realistically do that. So it's almost in a way becoming too big to fail, kind of in a different sense. I'm kind of curious. Did you see real world assets, we kind of touched on this, but do you see real world assets as being more sustainable and non-cyclical than traditional crypto collateral? I know MakerDAO's focus has traditionally been, borrowing against Ether and Bitcoin, and now it's moving more into real world assets. Is real world assets necessary to scale DeFi and prevent this kind of recursive capital rotation loops that a lot of DApps have been kind of stuck in for a while?
Yeah, so I think the answer is yes right now. RWAs are they are less violently cyclical for sure, but I think that's more a function of just how young crypto is. Price discovery is pretty violent still, and I think as things mature, you'll ultimately just see capital market like activity and the volatility associated exist in crypto as well, I think, as the pools of capital get bigger. But what I think it's kind of important and gets to your point about how do we get out of this sort of snafu of reflexive sort of yield farming and simple circular games. RWAs are important because their yield, at least for now, is more predictable and uncorrelated with crypto yields. And I think that's what's important in kind of a market like this, where, look, at least for Maker, our product is lending against crypto assets. When those crypto assets prices are low, there's less demand for that leverage, right? And when that demand dries up, so does our revenue. So in order to make the protocol or any protocol more resilient to crypto market swings, you look to the real world where rates are actually rising, right? And you say, how can we marshal some of that yield, that more fixed, predictable yield, collateralize against non-circular assets, and how do we bring it into this system? I think your second point, does crypto scale without incorporating these assets? I think absolutely not. Ultimately, the crypto market cap is roughly $1 trillion. Maybe it's a little bit lower today. Real estate, fixed income, and equities are $650 trillion, right? So most of the value in the world, does not live on our distributed ledgers. It lives elsewhere. And so I think, for crypto to fulfill the potential we all hope it has, for it to be sort of a, internet was for information, what crypto is for value, type proposition, like those tracks must be laid. Those assets, ultimately, for us to be successful here, they've got to live on crypto rails. We've got to bring crypto's fundamental strengths, whether it's transparency, trust minimization, determinism, to that world. And if we don't, I think we're definitely undershooting what could be built on this tech.
Yeah, I think you pretty much echo my sentiment here, that real world assets are really the way forward, and actually introducing total addressable markets that are multiple orders of magnitude bigger than anything we've ever built previously. I think the value proposition, I think, is increasingly clear, but of course it's not going to be a clear riding road. There's going to be many bumps along the way. We kind of talked a bunch about the regulatory roadblocks that exist, or at least there has to be. We have to work some way in the regulators, or maybe beat them to the punch a bit. But what do you see as the other primary challenges and roadblocks to tokenizing real world assets? I'm sure there's numerous that you've run into in your experience.
Yeah, we're just at the very beginning of dealing with these challenges. But yeah, so I mean, regulation is, I think, one piece. I'm actually more I'm kind of more hopeful and optimistic about that than most. I think regulators will be surprisingly thrilled with what's happening on the real world asset front, and figuring out that these systems are in fact trying to incorporate existing financial systems as opposed to tear them down and rebuild. But there is this interesting dynamic with tokenization of real world assets right now, which is, what is the token? What does it entitle a holder to? Is a token just a representation of information? Is a token telling me the value of this asset, its performance, where it is, yada, yada? Or is a token in my wallet ownership of the underlying asset? And so I think this idea of legal acknowledgement of ownership is a key thing. There are certain jurisdictions like Singapore and particularly Switzerland that have seen this really what is an opportunity to you know, build a legal backing to the ownership of a token, which is to say owner of a token owns underlying asset. And they should accrue, you know, significant business activity through that. But until more jurisdictions, you know, remove the uncertainty around what a token entitles its owner to, you know, we're nowhere near the full potential of this system. I think another key weakness here is kind of packaging and distribution. So it's really the infrastructure for ingesting these assets, combining these assets, and then distributing the yield out to various DeFi participants. I think this is really where kind of the Oracle solutions, the liquidity pools, the kind of, you know, smart contract waterfalls, that's where all this stuff comes in. There's just not enough seasoned tracks on chain for the, you know, a torrent of assets of real world assets to come into the mix. And I think the other two, which are kind of we're kind of embedded in the first 2 points, are demand. You've got this weird snafu where, you know, degens want high yield and RWAs are giving you, you know, a fixed 5 or 6%. It's just not that interesting. And then on the asset manager side, on the supply side, you know, these guys have been doing their business the same way for 25 years and they know it well. And, you know, why are they going to take, you know, some technical risk bringing their asset onto some tokenization platform? So I think there's a snafu. And finally, really is the oracles. I think we undershoot the potential of RWAs on chain until we really wholesale revise kind of the valuation and oracle mechanisms here. You know, it's a trope, but these systems are only as trust minimized as the most trusted link. And until we revise those primary oracles, whether, you know, it's a 60-year-old man appraising real estate or anything else that's trusted, I think we still have room to go. So I would say legal, this idea of distribution, the demand snafu, and oracles would be kind of the 4 constraints that I see, at least in the near future.
I wanted to jump in on a quick point. Well, 2 points. One, you know, I thought you brought up something really interesting. You kind of touched on it again, although in more of a negative light. But, you know, this idea of having this kind of 5% yield. And, you know I agree with you that most people in crypto, they view it, well, most retail people, they view it as the lottery ticket, basically. But I think, you know, if you're getting 5%, you're beating a lot of the market. But this idea of having a kind of, I see it kind of like a hedge. So when crypto's not doing well, you have this alternative that people can go back into, as opposed to just like basically full risk on mode. You can actually have this like hedge. This has kind of been what stablecoins are, but we're kind of been limited to stablecoins, whereas real world assets creates this like massive pool of kind of more risk, you know, less risk adverse assets. And the other thing I was curious about, like, do you run into any like privacy challenges with bringing real world assets on chains, like deals, like legal stuff about the deals or about people involved, you know, needing privacy? Like, and I know, like, you know, transparency is such an important thing with real world assets. So do you see like any privacy challenges?
Yeah, I mean, 100%. I mean, to your first point, I think it's a good one, right? When you think about, you know, building an application, I mean, in Maker's case, you know, we have a balance sheet, and we want to continue to drive revenue to the protocol. And so to have this sort of flexible ability as a sovereign issuer to move away from crypto loans when rates are low and volume is low, and take advantage of real world rates, especially when they're going up, is really nice kind of anti-fragile kind of characteristic. And if you think about it, right, crypto loans are, you know, even forget the, you know, the short-term cycles, the fact that prices are low, but it's a commoditized product. It's not a difficult product to do. You lock up some crypto collateral in a vault and you lend against it. It's basically riskless. And as we see with all riskless activity, whether it's an exchange or crypto lending, it'll trend towards zero. And so more long-term, I think we got to think about, you know, what does sustainable revenue look like over the long term? And I think for Maker, what we've very quickly realized is you need to integrate real world assets because crypto lending is going to commoditize. But more so to the other point, I mean, it's a great one. I mean, privacy in real world asset lending is absolutely critical, especially with consumer credit, but just in general, like you're dealing with sensitive information about people, their assets, their history of performance, their history of bankruptcy, like all this stuff feeds into the credit process. And like it's cute, or people look at crypto and they're like, it's cute that you're transparent and you're open and everyone can audit, but I don't want my information open on chain. And so I think what it kind of gets to is, how do we drive towards a standard? What I like to call the maker standard for real world assets on chain, and transparency without revealing the actual information of borrowers. And we'll talk about HVB a little bit later, but there are sort of interesting ways to confirm information is true and to put that on chain, whether it's IPFS or on the Maker Forum, without unnecessarily revealing specific information, dispositional information about borrowers. The obvious use case here is, and it will be built, my brother who works at a fund has actually put forth a kind of a beta, but this is a perfect example of where a ZK solution that brings performance data on chain without revealing things solves a problem in the market. It's almost like this gap in the market that if solved, a flood of RWAs come on. But yeah, I mean, this is something we're ultra sensitive to. If you go too far and you sort of invade the privacy of an asset manager or of a user, of a borrower, that really tarnishes the space. And as the leader there, this is something that we're absolutely ensuring to be overly conservative on.
Yeah, I think it'd be a good point about zero knowledge proofs. I think that's definitively the way forward of being able to prove data about the credit worthiness of a borrower without actually revealing who they are, what their credit score is, what assets they own, or anything else about them. I think that's probably the way forward. Do you see, it's kind of like almost getting into the topic of like the Oracle problem. Do you see there being any other challenges? How do you think that oracles should be approached for real world assets, and what's kind of the scope? Because oracles for traditional vaults is pretty much just like, what's the price of Bitcoin? You deliver that price, it's ingested, and then it determines if a position is liquidated. But with real world assets and its structure, it can get a little bit more complicated and you need a little bit more, maybe some more trust in specific auditors or evaluators. What's kind of the problem space here, and how's it different than traditional price feeds?
Yeah, so I think the question of how to upgrade the Oracle solutions for real world assets is a good one. And I do think unless we really look at how to make that process more robust and more accountable, we've only solved so much. What I think is a little bit tricky is when you think about a real world asset and what an Oracle would be used for, it's really about valuation, right? What is this thing at a certain period of time? And in general, think about something like real estate. I sort of made fun of the trope of the real estate appraiser. It's typically an older man with a clipboard and a little algorithm for how to value a row home in Manhattan. But ultimately, the thing about these assets is they are complicated and they do require local knowledge to understand what the price of them are. And so when you say, well, let's apply a decentralized Oracle solution to valuating real estate, it's like, well, what are we really solving there? Because you have people with a deep trove, an entire career of knowledge trying to understand what this asset's worth. Who's to say a decentralized solution that was spun up yesterday is any better? But I do think the key here is, rolling out an Oracle solution for real world assets that is more accountable and it is more robust. And so this idea of cryptographic truth not being, it's a better, it's objective, but it tells you who said what about which asset and when, and they sign that on chain, right? And so you can have a history of sort of valuations for a specific asset that changed as per certain conditions. And anyone who's investing on chain can go and look at, what is happening there. And so I think over time, what's so interesting about these on-chain Oracle solutions is, you can use something like on-chain signatures and slashing of bad inputs to generate a reputation, a long reputation on chain of sort of quality of submission. And I think at that stage, you have sort of this network, this web of reputable oracles on chain, each of whom is checking up everyone else's work. That really enhances the process. But it is going to take a long time, because right here at T=0, these domain experts who have spent their careers understanding what's the value of a bond, what's the value of real estate, what's the value of 1,000 photovoltaic panels in Boise, Idaho. They're going to have knowledge that, a decentralized Oracle network won't today. But I do think one day, based on these fundamental strengths of decentralized Oracle systems, we will see a wholesale revamp, but it'll just take time.
I'm so glad you said that, because this is something I've thought a lot about. This idea of, people want like the 100% truth on this or that, but a lot of times, like, you can't, there is not like one single answer. Like when you say what's the value of real estate, well, there's not like a answer. It's not a deterministic input, it's not a deterministic thing. But this idea of tracking someone's history over time, and then actually really looking at how reliable this person has been over a long period of time, and then potentially slashing them. Not only you could slash him like, in the future, per se, on things that they've maybe got way wrong outside of some threshold, or so this idea of reputation stemming from how you input over time, I think is fascinating. I've also, like, on a side point, like, how could you do this to maybe media and journalists and science, and like this could really, like, this goes beyond RWAs, but you could do this far wider than just that.
Yeah, I mean, 100%. I think, and I know you guys kind of love this stuff, but I think, on-chain reputation, in 15, 20 years will be one of the most powerful forces that just governs our world, right? Because you'll have these parties who have such a deep, incontrovertible history of, performance, of good faith contributions, of coordination, collaboration, quality, whatever. And they'll be able to unlock just so many more opportunities than those bad faith actors. And so, yeah, I think CO, you're right. Like, whether you apply it to risk assets or literally any domain, this track record of immutable reputation, I think, is going to be so important going forward. And to be honest, I think it solves a lot of, societal ills. I mean, you kind of avoid this prisoner's dilemma if you're like, look, you need to generate a good long-term reputation, or your earnings power is notably reduced by whatever, 100x. I mean, that force, that's powerful, and that's going to affect the way people think about economics.
And when you put people, kind of their opinions all on like a platform where everyone can view, they become very easy to compare. Like right now, a lot of people make statements, but they're in their own little their own little isolation, and their community doesn't see it against other communities. And it, like, if you like kind of aggregate these and you track them over time, you could actually do a very good analysis, over time of someone's track record. So because I see a lot of times people make statements, but they don't actually have to defend those statements,
right?
Or they delete them and they delete the track record of them. So anyway, it's kind of a side tangent, but a very interesting, I agree with you, a very, very interesting concept, this thing of on-chain reputation.
And I think it's an interesting topic, since it's just like the reputation problem. I think that, like, you can bootstrap your reputation over time, and then at a certain point you could have incumbents. And if you're a new entity who wants to build your reputation, you could potentially bootstrap your reputation by putting the capital up as collateral. And then over time, as you become a more trusted and proven entity, you could basically reduce the capital requirements of your statements almost. So I think it's an interesting dynamic. It's a hard problem. I think kind of when it comes to like the quote unquote Oracle problem, I think that it's almost like what something's worth and where something is. I'm kind of curious, when an asset is tokenized on chain, then it exists on chain and the token is the asset. But when you have a token representing an off-chain asset, there needs to be some kind of link proving that that asset actually exists. So I'm just kind of curious your thoughts on the role of proof reserve, and if you think that's something we'll see at scale, or if that's just kind of temporary until all tokens are the actual the actual asset.
And if I could add to it, it's not just that it exists, but also a lot of times like the condition that it exists in as well.
Yeah, so I think you guys are, I mean, basically the question is, at the current stage of RWAs, like what do our oracles look like? I mean, how do off-chain activities get reflected on chain? And so I think, having gone through this HVB transaction, which we'll talk about for the last 3 months, we've had to build kind of a custom oracle, if you will, that sort of delivers to DAI holders and MKR holders who are really taking this risk, a sort of peace of mind around sort of the collateralization of the vault, and B, the performance of the underlying assets. And so what we did is we kind of built in an auditor into the system, a group that we spent 2 or 3 months finding, a sort of an adaptive off-chain group that basically what they're doing in this structure is they're saying, are these assets that the bank is submitting to Maker for funding eligible as per the vote that MKR token holders had? And is the over collateralization ratio reflected by sort of the cash held off chain and the assets value calculated off chain sufficient such that the vault is compliant as per Maker's requirements? And so it's not just an off-chain originator is marking their own assets, they're managing their own cash, and then they're selling stuff into MKR, right? We basically have a custom Oracle solution built off-chain to kind of deal with this proof of reserves, this asset type eligibility issue. And that entity then it submits this information on chain in sort of a comprehensive report that details to MKR holders what's happening with the collateral, how it's performing, how much interest has come in, and they're signing that on chain. So it is sort of in its absolute nascency, but what we're hoping is that each and every deal, right, it looks more like the kind of trust minimization and transparency that we're accustomed to on chain. But you can't just go 0 to 100, right? I mean, these systems take time to build. And as we're building towards kind of the Maker standard, what we do on each and every deal is we ask ourselves the question, what upgrades can we make to this structure based on our understanding of sort of crypto economic strengths to make it look more like the world we're used to? And then we build that in. And I think over time, the Oracle solution being no exception, all of the middleware of this bridge between RWAs and crypto, it's just going to become better and better and better and less trusted, more robust, more transparent, but it does take time. I think proof of reserves is a super important use case, especially because when you think about an asset manager coming to crypto, like sure, they might be comfortable with Ethereum or the developers they're working with are comfortable pushing data on Ethereum. But I think what's important about like a proof of reserves sort of solution, like on Chainlink is Chainlink's kind of this abstraction layer, or is the way I see it. It's sort of an anchor. It kind of hooks into different L1s. So if you're an asset manager and you have information about, an amount of cash that's in a vault, maintaining a certain over collateralization ratio, and you want to ship that information on chain into various consensus environments, I think something like proof of reserve is probably your simplest out of the box solution.
Yeah, I think that there's kind of a distinction of like the Oracle problem can be broken down into like the data delivery problem, how do you get data on chain, and the data quality problem of what is the data itself actually saying. So I would agree with perspective. Chainlink is basically like an abstraction layer of facilitating the ability to get this data on chain. So the Oracle space it's definitely an interesting one for real world assets. I think it's kind of shift what it means to be an Oracle. It's not just a price feed, but it's actually much more about all of the metadata that surrounds the state of an asset and the state of its eligibility to be used within a protocol. I think stepping beyond this conversation, I think it's worth stepping into. You mentioned a couple of times with the HVB deal. Could you provide a little bit of context of like what MakerDAO is doing here, and what exactly is the HVB deal? I think it's a very exciting initiative, but I feel you can likely explain it better than I can here.
Sure, happy to, gents. Yeah, so this is a $100 million real world asset deal that was just approved for funding at MakerDAO. The party on the other side of the deal is Huntington Valley Bank. This is a 151-year-old, fully regulated Pennsylvania bank. This deal is interesting. It's a participation facility. So what that means is, rather than MakerDAO, lending to HVB or against their assets, what happens is HVB, a bank going about its normal course of business, will issue, a commercial real estate loan, a business loan, whatever else they do in their course of business, and then they'll sell off a portion of that loan to Maker. And so Maker will fund that loan with DAI, and then it will have a real world asset on its balance sheet. But I think it's important to recognize this difference between, Maker really being a buyer of participations and Maker lending to HVB. Sort of second point about this deal, it's really interesting for Maker because it's sort of turnkey, this facility. And what I mean by that is, I think it's really important to recognize what Maker's good at, or what crypto's good at, and what it's really bad at. You've got this party, HVB, and they are really good at what they do, which is go out into the real world. They're a community bank. They understand, their jurisdiction, their asset types. They know their business. They've been doing it for 150 years. And for Maker to understand what it is, which is a flexible, scalable source of capital, and to really let HVB go out and do their thing. And so for Maker, this is a out-of-the-box, diversified yield solution. HVB originates assets, they service those assets, they work out those assets if that's needed, and Maker sits there and we collect the yield off these participations. So I think that's a kind of an elegant structure whereby two entities, each of which has its strengths and weaknesses, combine into one kind of symbiotic whole that really works for both parties.
How long does this? I mean, I probably don't even know, but how long is this like loan structure? Like what's the maturity of like how long it takes to pay back and the interest? Like how does that work?
Sure. So the longest, we set up the facility such that HVB at maximum can originate 5-year loans. And so what that basically allows for is, as long as HVB is paying monthly interest, or even if they're not, MKR holders have the ability to wind down the facility in sort of due course. But it is important, I think, here to understand that 5-year cap was very much deliberate. If you think about the other side of Maker's balance sheet, it's really these DAI deposits, right? It's kind of like a banking deposit. As long as your deposits are there and they're sticky and users don't want them back, you can go ahead and lend them out. But if a user redeems their deposit, you really have to honor that. And I think that's kind of critical, especially in the wake of, all these kind of CeFi nightmares, Celsius, Nexo, whatever. Like, you must respect a user's right to withdraw. And so that's kind of our liability side, right? And so, if we're onboarding assets that are, 20 years, and, DAI deposit holders want to redeem their DAI and we can't honor that because we can't get rid of these 20-year assets, then that's a problem. So it's really important to think about RWAs not only in terms of the credit risk to the protocol, the odds they pay you back, but also kind of the liquidity risk and ensuring that the nature of those assets kind of matches the nature of your liabilities.
So what I read on the proposal is like the initial size that you're focusing is about $100 million for this deal, and ideally scale up to $1 billion over time, providing 3% yield or so on that capital. Though it's clear that traditional institutions can't really touch crypto yet, and that includes even crypto native stablecoins like DAI. So what is the conversion process like for converting DAI and USD, between each other? How does that process work exactly?
Yeah, it's a good question. I mean, we would love for one day this to be direct DAI for assets, but we're not there. So we're using kind of a very simple structure here. We've got a trading agent, a reputable trading agent that sits in the middle. And as DAI leaves the protocol, they swap that DAI into dollars, always in single day settlement. Right? We recognized this trading agent as being a potential weakness to the structure, i.e., if DAI is sitting on their books for too long and for whatever reason, that counterparty disappears, that's not a risk we want to, subjugate the Maker protocol or MKR holders to. And so we're shipping DAI out in 4 shipments to ensure that that DAI can be swapped to dollars, single day settlement. It only sits on the books for a little bit. That trading agent then ships those dollars to a trustee, which is basically, the trust is Maker's, real world arm for the purposes of the structure. And then, dollars are swapped for the underlying loans. So we're just using a very simple trading agent who swaps DAI to dollars on the way out. And then when principal and interest come back in on the underlying loans that we own, that same party will do the reverse, swap to DAI, and then pay DAI down to the surplus buffer at Maker.
Could you dive a little bit more into what specific assets are actually backing this newly minted DAI? It seems like it's mostly the real estate in a specific area of the US market. Do you see this as being a particular risk if Maker becomes too overexposed to this particular area? What's your thinking here?
Yeah, so I think this is actually pretty interesting. So as I mentioned, this is kind of a diversified solution, right? So we have not been overly punitive in terms of what HVB is allowed to originate. We've agreed with the bank on certain constraints, on certain characteristics, and that includes asset type. So under the docs of this particular facility, HVB can originate commercial real estate loans, construction loans, government guaranteed or not business loans, as well as a few other types that we've put pretty low caps on, such as residential real estate and consumer loans. But the idea here really is to give HVB the flexibility to execute its business in the best possible way, right? HVB is sort of, taking a risk in that they are integrating with crypto. They're the first bank to ever do this. And so, we are trying to deliver them a product that enhances as opposed to constrains their business. It's very obvious what this does for Maker. It gives us an out-of-the-box yield solution. And I think it's important to recognize, to your point about maybe some exposure to idiosyncratic risk, whether it's commercial real estate, whether it's the certain geography of the US, HVB must retain at least as much of every loan that Maker does. And so what that basically means is, we've taken a look at this and we've said, how do we structure this thing such that Maker is protected? And I think the way you do so is you ensure that the originator of the loan also holds the risk of that loan on their balance sheet. So when you think about HVB's incentives here, my Wi-Fi went out, so I'm on hotspot.
No worries. You were like halfway through answering that question.
Yeah. So I think it was just saying, you guys had kind of mentioned the potential risks by being overly exposed to a single asset class or a single geographic location. But we recognize that, and we tried to build a structure that would ensure that HVB be as sort of prudent and cautious with their origination as we'd like them to be. And basically the way you do that is you ensure that HVB as the originator is not just originating to distribute, which was sort of the pathology that we saw in 2008, but they're originating a loan, they're selling us some of that loan, and they're retaining a large piece of that exposure. It really ensures that they are acting in Maker's best interest and that everyone is aligned.
So you mentioned before that HVB initiates a loan, a commercial loan. They own 50%. They sell 50% to MakerDAO. And then is the loan for DAI just taken out against the 50% that Maker owns? So if there's $100 million of assets, 50 million belongs to Maker, then can your MakerDAO is basically buying, exchanging $50 million of DAI for $50 million of real world assets that generates 3% yield. Is this kind of the general structure? So like Maker's not lending to HVB, but it's buying interest generating assets. Is this kind of the structure here?
Exactly. Couldn't have said it better myself. The one thing I'll say is the 3% number, the facility really should net out much higher than that. We set it up with a minimum yield to ensure that sort of HVB was exceeding that minimum hurdle. But as we mentioned before, HVB is going to originate these assets at market rate, which will be at some spread above the like term U.S. Treasury. So we should expect higher than 3%. But CLG, your breakdown of the way the facility is structured, the process is exactly right. So we're only swapping DAI for our piece of the participations. So if the facility is fully used, we'll have 100 million DAI outstanding against 100 million of assets, Maker assets, and HVB will have another 100 million, the other half of those assets we are participating in.
Gotcha. Okay. I think the benefits here for MakerDAO, I think, are fairly clear. You can diversify your books. You can generate more revenue in a time when revenue on crypto-based loans is driving down, as you mentioned before. But why is HVB dealing with MakerDAO? Like, what does HVB get out of this deal, and why are they making this initiative and taking on this you could put it technology risk to push this forward?
Great question. Why are they taking the technology risk? So I think there's two pieces here. One, which you kind of got to understand the constraints that regulators put on these banks. One of the constraints that HVB must respect is a maximum exposure to a single borrower. So as currently structured, HVB can have no more than $7 million out to any one borrower. This is really constraining because if you think about what HVB is, it's a community bank. Community banks have their edge in understanding their existing customers and growing with those customers. So what that means is if they have a really good customer who they have a commercial real estate loan out to, that's a $7 million loan, right? And that customer is successful, they spin out another business, they buy another rental property. HVB cannot grow with that customer, which fundamentally hurts the value prop of a community bank. So what does HVB end up doing? Well, what they end up doing is they end up originating $14 million of loans with a single customer, but then selling off half of those to their competitors, right? Which for obvious reasons is not ideal. So what this structure basically allows for is it allows for HVB to draw on this sort of flexible pool of liquidity, this $100 million of liquidity, and sell in half the participations and really grow with their customers without the risk that the new holder of those loans, being Maker, is going to compete or cannibalize their business. Well, I think that's the first key sort of quantitative advantage. The second is, I think it's a matter of kind of brand, really. So HVB, is a community bank. It's not the sexiest sector. It's more sexy than recycling, but less sexy than crypto. What they're able to do here is, they're able to kind of become a savvier, more deeply tech-oriented financial institution, which I think is kind of great for their brand. And if you extend this logic out, HVB maybe, over the next few years, depending on how big this facility gets, how much we kind of innovate on this Maker standard, grow a partnership together, you could see a future world where HVB is valued more as a technology company and less like a community bank or a credit union. So I think it's really those two things are why, HVB is in this, and they've been, a true joy to work with. They're proper frontiersmen. It's a community bank in theory, but you go, you visit their offices, you see the way they do business, you see their aggressiveness to integrating with this new technological paradigm, and they're a really impressive shop. And I think they see kind of the writing on the wall. They see the fact that things are changing and crypto is here to stay, and I think they want to associate their brand with kind of the frontier.
Yeah, it's kind of interesting. My thesis, just kind of in general with DeFi, is most end users are not going to, open up MetaMask and interact with an application directly, but rather they're going to continue their existing relationship with their financial service providers and fintech apps. And then those applications and institutions will be using DeFi on the back end. So with this deal, technically the consumers and the users of HBV are using Maker. Not directly, it's abstracted away via the bank's operations, but they're effectively using Maker, which I think is it's incredibly interesting to me. And correct me if I'm wrong here, but HVB has about $500 million asset under management. So, this is not a small deal for them. This is a pretty significant deal that will allow them to significantly grow faster. And it's a very definitive real world use case of accelerating their business, not speculating on crypto tokens, but just growing their business. Do you see more banks being onboarded to Maker in this fashion, using the same kind of trust structure you've already created, just expanding horizontally? What's kind of the vision here?
Yeah, so I think this deal and a deal we are finalizing in parallel, a covered bond deal with Societe Generale, the huge French bank. I think this really opens kind of a new era for Maker's optionality, as well as our legitimacy as a player in credit markets. To answer your question directly, I think we're now at the stage where we're just getting flooded with inquiries from really good institutional counterparties. To be honest, I don't want to, and I hope I can convince the community that we don't want to scale horizontally across other just purely high reputation commercial counterparties. I'd like for each and every deal to be an improvement in terms of trust minimization and innovation over the last. So look, to the extent that an institution is actually keen to work with us and to iterate on a structure that conforms to the Maker standard that I'd like to see us building for this industry, then great, we're all for it. Obviously a stronger counterparty with a reputation for expertise is better than one that doesn't have that reputation. But make no mistake, we're not in the business of just jamming DeFi into TradFi and underwriting a $1.5 billion loan to Goldman. If it were structured correctly and Goldman wanted to work with us in a way that we could really build a robust standard with good oracles, trust minimization, everything on chain, ZK proofs, yada, 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 great. But the deal that comes after HVB needs to be better, more robust, and more trust minimized than the last. So I think that's the cadence we're going to take.
So it sounds like to me, really what you're advocating for is to continue refining the template that other real world assets can use in the future, as opposed to just trying to ram them all through with a very initial solution. And so like working with partners to actually keep harnessing that template to where it's in such a good state that you can really start to scale out it using that template.
Exactly. I mean, we want this, like, we recognize that Maker is uniquely equipped to accelerate this revolution. I mean, it's a duty of sorts, right? Maker has a sovereign balance sheet. What it can say is, we know based on our experience with the renewables revolution that until the right thing and the economic thing are the same, nothing happens. And so Maker can sit in this interesting position, which is we can incentivize with our balance sheet the sort of change towards transparency that we want to see in capital markets, right? We can galvanize that revolution, and we're going to do that, right? And I think with the other sort of infrastructure partners building at this intersection, whether it's Centrifuge or Maple or Chainlink or Spectral or anyone else, we can be the piece of that stack that galvanizes change, this Maker standard, through economic incentives, and I think we plan to do so.
That's kind of a refreshing view for crypto, considering a lot of projects are just kind of growth, like just gotta expand horizontally, vertically, gotta do everything all at the same time. And it seems like what you're kind of pitching here is that Maker has a lot of leverage in its position as the primary decentralized stablecoin and primary lender in the crypto ecosystem, that you can use your leverage to actually build an ecosystem that's more trust minimized and transparent. And so you're basically purposely limiting your own growth for the safety of Maker and for the safety of the ecosystem as a whole. So it's commendable, and it's a unique approach, but I think it's honestly the right approach to take things right and carefully. I'm not sure if you have any plans in place, but what do you envision as being the next evolution of this structure? Like what needs to get introduced for this next big deal to seem very viable for the Maker community, do you think?
Yeah, so look, I think for the next deal, it will look. I mean, look, we don't exactly know what the next deal looks like. There's a lot of stuff in the pipeline, and I think ultimately something that Maker needs to come to consensus around, which I seek to address in a piece I'll publish shortly, is what is the North Star for RWAs? What do we want to achieve? What does success look like in 2030? And if we can come to consensus on that, then what does implementation look like next month or the month after that? What does this next deal do? Like, how do we back into implementation? And so I think like ultimately this Maker standard, I think, has sort of two prongs. Like, I call them rebirth and birth. Rebirth is, let's bring existing assets, we call them real world assets, off-chain stuff, onto the Maker standard, right? Let's incentivize a change in the way they're ledgered, reflected, et cetera, et cetera. The other piece is birth, which is how do we mint for the first time completely novel assets on chain that have credit risk? And I think that's ultimately where I'd like the next deal to come from. So, something like, for example, I'm not going to give any teasers, but an asset that would fit this bill is hash power backed loans tokenized under Swiss law, right? Where we could hold a token on our balance sheet, and that token entitled us to the underlying payment from BTC miners. So I think either way, what the next deal looks like is it takes these innovations that we've built into HVB, particularly a colleague Christian of mine has built into HVB, and we upgrade them and add new ones if it's sort of a rebirth deal, if it's existing RWAs that live out there in the real world. But on the other side, if it's a birth deal and it's sort of, we built a proprietary structure that allows for a completely new asset to live on chain, I think that will also be appealing to the extent that the asset is safe and it fits kind of the risk profile of Maker. So I think just the key is, the infrastructure continues to evolve and it's an improvement upon the last.
I had a question, TJ. I kind of, Maker's kind of pioneered, DAOs kind of I think I may be wrong here, but I believe they're like one of the first DAOs. And I'm just curious, like, what are the benefits, but also the challenges with having a DAO structure, but then trying to, do these type of very complex deals where, not everyone, a lot of people, it's going to be very hard to understand all the different details. There's going to be a lot of different opinions, of people who have been around a while, you have new people. Like, what are the challenges, the benefits and the challenges of doing this through a DAO structure?
Yeah, that's a great question. I feel like you guys are diving right at the core of the machine here. So I think there are some benefits to decentralized governance. In general, it becomes more difficult to corrupt a system where ownership and sort of voting is distributed. So to the extent that some external actor, right, had a real world asset and they wanted to jam it through the protocol, if one party owned all sort of the MKR stake and that party, were bribed, for example, to use a hypothetical, it would be easy to, milk the golden goose, which is Maker there. But if governance is decentralized, it becomes a little bit more difficult to do so, and thus the system is more resilient. I think that's the positive side. I think the negative side, which CO you got to very incisively, is RWAs are incredibly complex. They require an understanding of macro risk, of micro risk, of the asset class itself, of the asset manager, all of this stuff. And so, to what extent can a decentralized group of token holders, make better decisions with regard to those assets than domain experts that have spent their careers doing so? And I think it's sort of, it brings up this interesting idea, which is you got this product that's clearly evolving from something that is crypto native to something that's a little bit more hybrid. But yet the decision-making apparatus, governance, hasn't really fundamentally been changed to reflect that change to your product. As it currently stands, MKR holders vote on a lot of stuff, right? They vote on macro stuff like budgeting decisions, like new core units, which is our fancy name for new teams. But they also vote for micro stuff such as onboarding collateral, vault parameters, etc. And you have not seen, at least I haven't seen, maybe you guys can correct me, a structure, a precedent whereby there is a complex domain and each and every decision goes to referendum, where local knowledge experts aren't making decisions on behalf of, the local domain. So I think that's where things get really tricky, and something we're working through now, which is, does our decision-making apparatus work for where we're trying to go? And if not, how do we work from first principles to revise it such that it is in fact effective?
This is kind of related to this topic of governance, but there was a recent controversial vote on the MakerDAO forum around Love 1, or just introducing a new core unit to oversee the onboarding of collateral. What's your overview on the situation? Were you disappointed it failed, or did you want it to fail? Well, I'm curious on your perspective generally.
Yeah, so I was disappointed it failed. I think it would have brought sort of robustness and professionalization to the DAO. The prospective facilitator, who would have been the effectively the boss of that core unit, I'd worked with for a few months. His name is Luca. Just a fantastic contributor. I have nothing but positive things to say about him. But if you think about what the group was really trying to do, it was basically add another demonstration of how important structure and the pursuit of RWAs were. And so you sort of ask the question, well, like, what's not to like if Maker has decided on RWAs as a growth vector, and RWAs are complicated, and thus like another layer, sort of an audit layer, an independent layer overviewing the process by which RWAs are onboarded. What do we not like about this? And so I think the broader takeaway here is, what really happened is that vote had nothing to do with the underlying content of the vote itself. People weren't voting on whether Love did or did not survive. It was a sort of a proxy war. For whatever reason, people felt on both sides that this vote was indicative of something much broader about kind of the trajectory where the DAO would go. And so, people kind of, marshaled their assets, and it became sort of this split, for whatever reason, between kind of legacy Maker, kind of pure ideology, crypto native ideology. On the other side was sort of those trying to change the protocol, make it less trustless, and sort of bring in, big VCs who thought about things more commercially. And whether that was right or wrong, I think matters less, but I think that's why people made the kind of the decisions they did. Love did not end up passing, which I think would have been great for the professionalization of RWAs. But ultimately, these systems, to be quite frank, they are no different than any human power structure. And when certain interests feel that things are going against them, they will galvanize the resources required to push things in a certain way. So I think it was an interesting experiment for Maker, and even for broader crypto. But most importantly, maybe the takeaway is everyone showed up to vote that day. And so I think people only get excited and they get hot and bothered when they know something meaningful is being built. And I think we hopefully can take that energy and that excitement and parlay it into something productive.
Yeah, I think I agree with your assessment. It was definitely much more about the proposal itself. I kind of seen it shoehorned of like decentralization versus centralization. I think that's an oversimplification of what the situation was, but that's unfortunately kind of what the grouping was. Kind of stepping out of governance and kind of back into real world assets with the HVB deal. I know that that's not the first real world asset deal that MakerDAO has engaged in. Has Maker seen success in previous onboarding of real world assets? What's been the trajectory so far, since HVB is really just one dot in this graph?
Yeah, so I would say HVB is the biggest deal that we've done yet, and I think it's kind of the very beginning. That we hope that RWAs are in the billions in short order, obviously done responsibly. I think the RWA program really started with an infrastructure partner called Centrifuge, who we launched with. They built a entire protocol that allowed for asset managers to tokenize assets and Maker effectively lends DAI into those pools, and we absorb Centrifuge tokens that represent the underlying assets. And so we did a few turns of deals with Centrifuge right off the bat. I think the biggest is a facility, a pool with a group called New Silver, who originate real estate bridge loans, basically like value add renovation loans, mainly in the Northeast. And that's now I think it's a $30 million facility today. And we did a few others, sort of small pilots with Centrifuge, and we intend to continue to do those. But then I think when we got to sort of the last 6 months, and we're now onboarding this $30 million deal with Societe Generale, we're doing the HVB deal. And so there's a lot of deals in the pipeline now, as I've alluded to a few times now. And so there's no sort of shortage of good quality, diverse assets out there. But yeah, that's kind of been the trip so far.
How have you seen like the calls change? Like you get on calls with these people from traditional finance. Like I'm curious how the calls have evolved. Like
that's a good question. They've transformed completely. At the beginning, it was me and the team really begging to be heard. And we get on the calls, and the idea is to convince the asset manager to finance some assets through Maker. But 45 minutes of an hour call is explaining Maker from soup to nuts and getting over this hurdle, which is no, we're a legitimate thing. Maker's balance sheet is actually $10 billion, and they're treating it like it's a cute cyberpunk toy. But now the power dynamic, the script is very much flipped. I think people saw the collapse of Luna, and that was a pretty oddly good event for Maker. People saw kind of the collapse of these opaque CeFi structures. That was an oddly good event for Maker. And then HVB hit, and I have folks and institutions from my previous life calling up and asking how they can get in the door. And so I think we've crossed a threshold where a new kind of echelon of activity is possible. We've got all of these options. The question is, how do we take all of those opportunities and use the scarce resources we have to choose the right ones?
Yeah, it feels like in general, like the zeitgeist has really shifted towards real world assets, towards Maker, and just towards real fundamental values. Every other kind of Ponzi-nomic structure in crypto keeps collapsing, then the attention actually gets focused towards where the real value can be generated, and that's fundamentally real world assets.
It's nice to hear that too, because if you're on crypto Twitter, sometimes there's just a bunch of doom posting, so it's if you actually though look at the fundamentals of a lot of the stuff, I do think we went in an innovation lull, but there's a lot of big things also happening out there. They just get, they're not Ponzi-nomic, 100,000% APY, but they're like real long-term sustainable things. And the more those pile up, the more legitimacy and that brings the sentiment back over time.
Yeah, I mean, I think you guys may have mentioned this last week, or maybe I heard it somewhere else, but like it's easy to forget, amidst the price action and just the misery on crypto Twitter, um, the kind of the slow but steady improvement in fundamentals that we've seen over the last 2 years. I mean, I remember 2 years ago, you know, people, crypto wasn't really talked about. It was still a joke. And now, we have situations where, $100 billion real estate asset manager is, talking to Maker about financing loans. We have, this constant uptick in active developers and active wallets, and the tooling is getting better. And, you know, big asset managers are managing USDC reserves. JP Morgan is losing executives to whatever protocol. Like, things have changed, right? We're in a different world, and I think it's important to recognize that. And these sort of bear markets where the unsustainable stuff falls out, where it gets cold, I think are largely good. I mean, it hurts for a lot of people, but I think it's positive for the industry as a whole.
With things kind of shifting the way they are, I'm curious, what's your long-term vision of real world assets, and I guess DeFi in general? Like 10 years down the line, is the majority of collateral in DeFi going to be real world assets? Is it going to be people interacting with banks who use DeFi as their entire backend, essentially? Like, what's your kind of vision of how things go right in the future for DeFi?
Yeah, so I think if we look out a few years, this distinction between real world assets, as we're terming them, and crypto assets is hopefully gone. If we're successful, it's gone. I think we use that distinction because it is a sort of a function of where we're at today, and kind of the fact that the Maker standard and those rails haven't yet really been built out. But I think ultimately what we hope crypto is just this, kind of to your point, with the banks being the front end. We hope it's just this back end, like this plumbing for value and fit for an internet age. And if that is in fact the case, and it's similar to the internet in that way, in other words, it's not a speculative asset class, it's a backbone of a digital economy, then everything should really live on chain. And this massive world of value out there, that $650 trillion, you can see it slowly getting pulled from all these proprietary ledgers, and going to live on Ethereum or on IBC or wherever else. And I think that is what success does look like. I think if we don't attack real world assets, then, to be frank, kind of failed in a way. Your question about the banks being the front end that people interact with, I think the principle is right. In other words, crypto will be abstracted away, and people will interact with it through these sort of very convenient, friendly portals. I think the bank analogy, it's kind of the, when the car came around and we called it a horseless carriage, like it kind of uses like the previous models to map things into the future. And who knows, maybe I'm wrong, and banks are this fundamental fixture. But what I want to say is they either look much different, or kind of that front end is much different. But either way, I agree, whichever you guys said, that the average user is not going to be using MetaMask to interact with a protocol where they bring in their RWAs. I think that's right. I think it becomes very easy, the entire sort of pipeline of taking an RWA, ledgering it, packaging it, and piping it on chain, and then getting credit against that asset. It'll ultimately become super, super, super easy, and we'll have all the infrastructure. And I do think all these RWAs end up just living on chain, and then the distinction between RWA and crypto should kind of disappear.
Yeah, I think you put it well. I mean, eventually there won't be decentralized finance, centralized finance. It's just going to be finance. And that's where assets are going to live. They're not real world assets. They're just going to be assets. And the DeFi tokens that exist are not going to be the main story of like, how do we build infrastructure to speculate on tokens? It's more of, these tokens exist to govern these systems and then collect the revenue from that. But the actual focus of the system is finance, financing businesses and consumers and actual real value in society. So in my mind, I'm very aligned with that. I don't know if it'll be banks doing this in the future as the front end, maybe more fintech operations and probably crypto native front end operations, but it'll modularize between these two different layers. Crypto Oracle, do you have any last questions for TJ here?
No, I don't have any last questions. I just, what you guys were just talking about. Yeah, I think DeFi will just be it kind of like how fintech is. Like fintech is I mean, I think it's gonna be much bigger than fintech, but it's like part of a holistic financial system. It's not like one or the other. There's like a holistic financial system, and DeFi is this large, portion, like infrastructure within a larger that you can utilize in a lot of different things. I lost my train of thought.
No worries. I was just going to say, I think DeFi in general is kind of a poor term. It kind of shoehorns our industry into a specific model of like, we're trying to achieve ultimate trustlessness and decentralization, but it's really a spectrum. Like people like to come in with the gotchas and goes, there's the centralized part. It's not DeFi, therefore holding worthless. But like it's an oversimplification of what we're actually trying to build here. And that it's really, I don't know, in my mind, if we build something that's really trustless and decentralized, but it like doesn't really do anything, it's more of an experiment. It's interesting, but it doesn't actually generate value. And we kind of have to compromise on some values to generate real value for society. So in my mind, there's always going to be a compromise. It's not going to be 100% pure DeFi, but I think that's okay if we actually want to generate some real value here, in my mind.
Plus, you have this alternative now. Like, it's not like, if you want to go this more fully trustless model, like you can build it or it already exists. So it's not like there's only one system, and if you're not in this system, there is no other system. So even worst case, you have this alternative system that exists.
Yeah, I think just to add to that, to your point about, people like to get very black and white about, it's either fully trustless, completely censorship resistant, or we don't want it, right? That's kind of a not really a battle, but it was a battle that was playing out in Maker. This idea of kind of violating our founding principles around pure trustless collateral. But I think you're right. Like, just because right off the bat, when we're ingesting RWAs into this system, they're not as trustless. They don't benefit from the same properties as crypto collateral. Like, doesn't mean that we don't integrate them at all. What it means is you take that entire world of value, which dwarfs your corner of the world, and you say, how do we inject like little improvements and trust minimizing vectors into this such that we can have all of this value living on our rails? I think that's kind of the key compromise. If you want to make a dent and make an impact in the world, which I think ostensibly is what many crypto folks say we want to do. If we really want to do that, then you got to compromise, because the existing world is built a very specific way, has all these path dependencies. And so you kind of got to deal with that and work around that, I think, if you want to make a lasting impact, which I hope we all do.
Yeah, the future, it's very exciting. There's plenty of risks and opportunities on the path forward. I think that this real world assets are inevitably the shift forward. And I think this conversation hopefully provides a lot of context to people that real work is actually being done on real world assets, that this is very likely the path forward. It's going to take a little while to get this right, just the initial stages. But I'm really glad you joined us in this conversation. Do you have any last thoughts to give the listeners here, TJ?
Yeah, I would just say, I've been thinking a lot about, what kind of success looks like for Maker and for RWAs. I think it's just sort of important to recognize from my seat that, DAI, it's trying to be a money. And if you're trying to be a money, you kind of need to achieve a network effect. And it's very difficult to achieve a network effect if, you don't have a number of different avenues to export this crypto native money. So if you're just exporting in kind of crypto in the narrow halls of crypto, and I can't go into the real world, that's all of this potential network effect and users and value that kind of you're leaving stranded in the real world. And in fact, contrary to this idea that real world assets are, a departure, I guess, from the founding principles of crypto and of Maker, if you actually think about it, we could potentially, by making these systems more open and more transparent, invite in kind of the very businesses that are excluded from traditional credit markets. And so instead of a divergence, Maker was supposed to mint DAI and get synthetic dollars to any user on Earth. Now you're taking that same financial inclusion and you're potentially applying it to the entire world of commerce and industry. So I guess I just encourage people to kind of be open about what real world assets are. They're not this evil thing that come with TradFi suits that are trying to overrun your world. It's in fact an asset class that's much bigger and could really sort of enhance and diversify the world of DeFi.
Yeah, I think you put it very well. I think one thing I would recommend the listeners to do, I'm going to put in the description the link to the HVB deal. It's a little in depth, but I think giving a look at the summary and the overview of the risks and not the opportunities will kind of put things into perspective of how this shift is already happening. So I want to thank you again, TJ, for coming onto this podcast and discussing this topic with us. And I want to just give a heads up to the viewer that this is likely the path forward, and it's always worth having a discussion. And I'm interested in people's thoughts. So thanks for listening.
Thanks, guys, for having me.
Absolutely.